The amount of money you keep is the true indicator of financial success, not how much you make. That depends on how well you can long-term invest, safeguard, and conserve money. Unfortunately, most individuals are terrible at this. More than 75% of earners don't save enough or invest wisely enough to achieve modest, long-term retirement goals, and this is true even after 10 years of consistent economic growth and record-breaking stock markets. Nearly two-thirds of earners would struggle to cover an unexpected $1,000 expense such as a medical bill, car repair, or broken furnace. So guys, stay with me to the end of this video as I walk you through 10 financial principles that will enable you to succeed financially. Ready? So let's get started. Number 1. Set goals. Identify your short, medium, and long-term goals before taking any other action. This is a quick exercise you can complete while sitting back and relaxing, but it gives your financial plan perspective and purpose, keeps you on target, and keeps you from wasting your money. This action is quite motivating. You'll feel motivated to work towards your goal more quickly the earlier you set them. Number 2. Know what you've got and what you need. No matter what your age or wealth level, always know two numbers: the amount of money coming in and going out. Add up the cost of your rent or mortgage, utilities, food, petrol, and other essential expenses. I advise changing your lifestyle if you're unable to pay your bills. Spend less than you make. It's not that hard. Consider wants and needs carefully so that you can choose which discretionary expenses you want to keep. Keeping your Netflix membership may be preferable to foregoing your afternoon boost at the juice bar. Don't ignore little unnecessary costs. They build up. Number 3. Save systematically. Put savings in the same category as your power bill as an expense that is both obligatory and automatic. To avoid being tempted to spend the money, set up an automated transfer of funds from each paycheck to save consistently. You'll need to save less money in the long run to achieve your goals if you start generating interest on your savings earlier. This is the charm of compounding, which ought to motivate even those who are reluctant savers. When you earn interest, it is added to your principal, and the sum of your principal and interest is then used to calculate future interest. Think of a snowball at the top of a hill. You may push it down the hill, and as it gains momentum, it grows exponentially. That's your nest egg compounding. Number 4. Invest in your retirement plan. Put money into an individual retirement account, IRA, or a 401k for retirement. They may enable you to invest pre-tax funds or claim a deduction for after-tax investments and are either tax-free or tax-deferred. Making use of a 401k plan that matches employee contributions should be your first goal. Many businesses will match donations up to 4%. Don't pass up the opportunity to save for retirement at your employer's expense. Your ultimate goal should be to contribute the most each year possible. You can also invest in a Roth IRA, which allows your savings to grow tax-free and with no taxes when you withdraw the money in retirement. You can contribute up to $6,000, or if you're over the age of 50, $7,000 a year. Number 5. Invest for growth. The entire budget for growth should be committed to investments that you won't touch for 10 years or more. It relates to stocks. This could sound hazardous given the recent fluctuations in the US financial markets, but benefits greatly exceed drawbacks. An average bull market in US stocks lasts 8 to 9 years, with stock prices rising more than 400%, while an average bear market lasts 1 to 3 years, with stock prices falling by 41%. When the stock market has fallen, it has always recovered losses and gone on to break records. Number 6. Avoid bad debt. It's typically the most difficult step towards financial literacy. Avoid credit card debt, and if you must use a credit card, make sure to pay it off completely each month. While some debt like student loans or home mortgages has low interest rates and enables significant investments in your earning potential and wealth, credit cards have interest rates of 20% or higher. Do you recall the snowball effect? Your debt can quickly experience that, which will defeat your financial objectives. Think about what happens when you charge a brand new laptop computer for $1,500 on a credit card with an 18% interest rate. You will be charged a minimum payment of $37 each month per analysis. If you merely make the minimum payment, it will cost you more than $3,200 and take you more than 13 years to pay off that item. Get the lowest interest card you can find for that purpose and place other expenses on a different card that you can pay off in full if life isn't cooperative and you need to pay off a large bill over time. Number 7. Don't overpay for anything. Everyone from your mutual fund manager to Uncle Sam wants to cut off your savings and investments fees, commissions, and taxes. Even though you can't completely avoid costs, you can minimize them and save a lot of money over time. Think about the impact of expenses for mutual funds and exchange-traded funds, which typically range from less than 1% to more than 1% of assets annually. If you invest $100,000 and earn 6% annually, your money would increase to $430,000 after 25 years if no fees were paid. With a 1% annual charge, you would have $345,000 after losing $85,000. Additionally, by staying with low-cost investments, you may see larger returns in addition to saving money. Just be mindful of taxes. As your portfolio grows, keep in mind that it is best to hold tax-inefficient investments in tax-sheltered accounts, withdraw money from investments in the most tax-effective way, and refrain from purchasing mutual funds before receiving year-end capital gains distributions. Number 8. Protect yourself. Life is full of rough patches like job loss, injury, natural disasters, and theft. These unwanted occurrences could be financially ruinous, in addition to being physically and emotionally taxing. Think the worst and be ready. Try to accumulate an emergency fund that can cover expenses for at least 6 months. If that seems overwhelming, make smaller targets like saving up enough for 1 month's rent. Another follows. Put the money to work by investing it in a money market or short-term bond fund, which can be accessed quickly and offers greater income than savings accounts at the bank. Meanwhile, don't cut corners on insurance just because it's not required, like disability insurance and renter's insurance. Up to 60% of your income may be covered by your employer's disability insurance, but as your life may become more complicated through marriage or having children, you may wish to have additional layers of insurance. You need term life insurance if you have people who depend on your income. Number 9. Keep it simple. The greatest strategy is a straightforward, really inexpensive, diversified portfolio of index funds that equals the market return for the vast majority of investors, and most definitely for anyone just getting started. Avoid trying to outperform the market, disregard trending news, and check your results occasionally. Keep your political beliefs, hunches, and emotions out of your investment decisions. Understand that when you most want to sell, it's probably time to buy, and vice versa. Also, stay away from trendy investments like cryptocurrencies. Remember when 3D printing was going to take over the world? In addition to the likely scenario that the trend will peak as you make your purchase. If too many investors run for the door at once, niche investments may suffer. It's known as a lack of liquidity on Wall Street, and you may prevent it by sticking with big, established indexes like the S&P 500. Number 10. Seek unbiased advice. Be certain that your advisor has your back. Look for professionals who serve as fiduciaries, which means they prioritize your needs over their own and steer clear of conflicts like commission-based product sales. Make sure the fees are transparent. Typically, a fiduciary will charge a flat fee for a single session or a fee based on a percentage of assets. Alright guys, this wraps up the video for today. If you found this video useful, please do well to give it a thumbs up and don't forget to hit the subscribe button as well.